As we near the end of 2023, the Australian real estate market is becoming increasingly problematic. To describe the market in November, it is a story of overall cooling and market bifurcation. Some cities are entering a decline phase, while others are accelerating in growth. Australia's economic fundamentals are now characterised by the convergence of three major forces, indicating an era of large-scale property development. Sydney is set to add several 100,000 new medium to high-density residential properties, with Melbourne showing a similar trend. There are significant reforms in immigration policies, with next year's intake possibly halving. Overseas investors face another severe blow, with the costs of buying a property increasing by up to sixfold. These factors will fundamentally alter the supply and demand conditions in the Australian property market, leading to unique trends in various cities and suburbs. What was once a unified market will fragment into multiple smaller markets. With high interest rates and personal incomes returning to 2008 levels, how long can the Australian property market hold? Each of these points is crucial and could be the subject of a video, but today we're covering them all in one go, so you don't enter the holiday season with doubts and concerns. Make sure to watch until the end. Hey there, my name is Alex. Welcome to my channel where I share information about real estate investment, economic trends, and wealth creation. If you like this video, smash the subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it. Before delving into the three major forces that could impact property and economic trends in 2024, let's first briefly review the trajectory of the Australian real estate market in November. The trend in the property market for November is already very clear. Sydney and Melbourne have entered a stable phase, while property prices in Brisbane, Perth, and Adelaide are still rising. In Sydney, there was a 0.3% increase in November, a noticeable decrease from the 0.8% rise in October. Melbourne saw a 0.1% decrease in property prices in November. This trend emerged in the last 3 months. Our previous market prediction was that Melbourne would be relatively weaker in this market cycle, but we didn't expect it to enter the adjustment period so soon. Sydney is in its 10th consecutive month of increase, while Melbourne's market began to adjust after 8 months of rise. Any single-month property market price fluctuation within plus minus 0.5% is a stable phase. Therefore, Sydney and Melbourne are currently in a stable phase, and it might be more difficult for Melbourne to rebound once the downward momentum is established. Cities also in a stable phase include Canberra, Hobart, and Darwin. Out of the 8 major cities in Australia, 5 are in a stable phase, and 3, including Brisbane, Perth, and Adelaide, are in a rising phase. Perth is leading the market growth with a 1.9% increase in a month. Brisbane and Adelaide's growth rate are stable, with price increases of 1.3% and 1.2% respectively. The rolling 90-day chart also clearly shows the trends of these cities. Perth is still accelerating, but its growth rate is slowing down. Adelaide and Brisbane's growth rates are steady, while Sydney and Melbourne are declining, getting closer to zero. Looking at the number of the newly listed properties for sale, which represents the housing supply, the new listings in November exceeded the level of the same period in 2022. They were in line with the 5-year average. On the demand side, the number of properties for sale is on par with the same period in 2022, but below the 5-year average. This indicates that the supply and demand in the Australian property market are approaching a balance. However, the listings in Brisbane, Perth, and Adelaide are 30% to 40% lower than the same period last year, which has driven up property prices in these 3 cities. Regarding rental, the national average vacancy rate remains low at 1%. You shouldn't ask me if you can rent out a property, rather you should ask whether it will be rented out in 1 week or 2. In Canberra and Hobart, rents are falling, while in other cities, rents are rising to varying degrees. So to sum up the Australian housing market in November, the national average housing price surpasses the peak of the pandemic period in mid-November, reaching a new historical high. However, the increase is slowing down, gradually losing its upward momentum. The reasons for the market slowing down are 1. An increase in listed properties for sale, 2. Worsened affordability due to rising housing prices, and 3. High interest rate putting pressure on our ability to repay mortgages. We've also observed that high-end properties have almost stopped increasing in price, while the mid-range market, which makes up the majority, still has vitality, and the low-end market is gaining momentum. A month ago in episode 27, we talked about New South Wales planning new development zones by enforcing land rezoning to provide more medium and high-density properties. Just a few days ago, the policy was finally implemented and the details were released. Honestly, I was shocked. The scale and the number of new developments made me speechless. The New South Wales government has bypassed local council functions through legislation, forcibly rezoning land in 39 areas and providing future 185,000 medium and high-density properties. This includes 8 key areas in the first tier: Hornsby, Macquarie Park, Kellyville, Bella Vista, Homebush, Bankstown, Crossnest, and The Base. These sites are among those with the transport capacity. All land within 1.2 kilometer radius of these train stations will be rezoned. Low density to medium density to high density, and high density to even higher density. The rezoning will be completed by November next year, offering 47,800 medium and high density residences. The second tier includes 31 major transport hubs, where all lands within a 400-meter radius will be rezoned to provide a total of 138,000 higher density residences. I think calling this transformation an era of massive development is quite fitting. In last Saturday's live webinar, someone asked about the impact of this massive development in Sydney on property prices. Simply put, a large number of medium and high-density properties will flood the market in the coming years, significantly increasing supply. Standalone house prices may rise, but there will be substantial pressure on the price increase of medium and high-density properties. Some might disagree, saying that 1. Apartments aren't rising now but will catch up later, even without supporting data or reasons. With Australia's 26 million people each having an opinion, this is just one among 26 million, and I don't feel the need to argue at all. Number 2, even with the ample supply, the rapid population growth in Australia will lead to demand outstripping supply, and property prices will rise. The second point is somewhat reasoned and shows some thought. Those who think this way might reconsider their views after hearing about the second of the 3 major forces.
Well, last financial year, net overseas migration peaked north of 500,000 people, and we expect it to come down substantially next financial year. During COVID, we had our population going backwards for the first time since World War II. Then after that phase of COVID, the students came back, but it will come down substantially next financial year.
The Treasurer said the Australian net migration in 2023 exceeded 500,000 people, double the average of previous years. The number of immigrants and international students will be significantly reduced next year to address the current issues in the Australian property market. In 2024, the number will be reduced to 375,000, and in 2025 to 250,000, effectively cut in half. Why are rents and property prices in Australia rising while interest rates are going up and the economic is not doing well? Australians can't rent or afford to buy houses. The demand is too strong, and the additional 500,000 people in Australia have contributed significantly to this. Imagine what would happen if this force disappeared and demand weakened. Well, first, rents would face downward pressure, as would property prices. New immigrants and international students who rent or buy properties close to the transport hubs, schools, and city centres, combined with the massive development in Sydney we discussed earlier. With all these factors, do you still think medium and high-density properties will rise in price? I can't say for sure because I can't predict the future. But at least there will be significant pressure on the price increase of medium and high-density properties. And this doesn't even account for the diminishing third force, overseas property investors.
First of all, tripling foreign investment fees for established homes, then doubling the vacancy fee for homes owned by foreigners. We also want to substantially boost compliance and supercharge the ATO in this area.
I think everyone understands by now. First, the cost for overseas investors buying second-hand properties will triple. Although not specified, current costs include the FIRB application fee and the additional stamp duty surcharge. For example, an overseas investor buying a second-hand apartment in Sydney to live in at a price of $1 million, in addition to the standard $40,000 in stamp duty, will also pay $80,000 in stamp duty surcharge and a $14,000 FIRB application fee. Even if FIRB and local stamp duty remain unchanged, the additional stamp duty would triple to $240,000. Thus, the transaction cost for an overseas buyer buying a $1 million second-hand property in Sydney to live in would become $294,000. For a $3 million standalone house, the transaction cost could reach a staggering $924,000. This will be a massive blow to overseas investors buying second-hand properties. The only option left would be to buy off-the-plan properties or house and land packages before obtaining permanent residency. And this is exactly what the federal government intends to do, to stimulate the supply of new properties. However, the problem is that for 1 to 2 years after purchase, the buyers will still need to rent temporarily. Secondly, the federal vacancy tax levied on overseas individuals who own properties that are not rented out will double. Simply put, if overseas investors buy Australian properties and neither rent them out nor live in them, leaving them vacant, the federal government will collect a vacant property tax annually. The tax will be the same as the original FIRB application fee, but now it's going to double. A property is considered vacant if it's not rented out or lived in for over 6 months in a year. The aim is to bring more properties to the rental market. So the costs will skyrocket if an overseas investor is subject to both these taxes. Third, the government will grant the ATO more power to examine the tax situation of overseas investors, including the vacant property tax and capital gain tax on property sales. Those who want to sell and leave while also evading taxes will likely find it difficult this time. These three forces will greatly impact the Australian property market in 2024, especially with the Australian economy already in recession. These factors will only make things worse. Regardless of what the media says or how the government portrays it, a recession is a recession, and it won't change just because of how it's talked about. This is evident from the GDP figures for the third quarter released by the Australian Bureau of Statistics. Australia's GDP in the third quarter grew by only 0.2% quarter-on-quarter, almost stagnant. This marks the fourth consecutive quarter of decreasing growth rates for Australia's GDP, falling from 0.9% to 0.2%. The year-on-year increase was only 2.1%, indicating that the annual performance is even weaker than the inflation rate. The most alarming figure is per capita GDP, which fell by 0.5% quarter-on-quarter and 0.3% year-on-year. This decline is both compared to the annual figures and the previous month, and the rate of decline is accelerating. First, this is due to the reduced productivity from remote work in Australia. For example, where someone who used to produce $100 in value per hour now only produces $90. Second, there's a mindset among Australians to work less if they can, still lingering the era of Great Australia from 20 years ago, where the country thrived on mining and enjoyed superb welfare. Third, the influx of immigrants this year, some bringing money with them and others, like students, not. A considerable portion of these people in their first few years in Australia only contribute to increased consumption and inflation without creating value through work or business. This directly drags down Australia's per capita GDP. Australia is getting poorer and has actually entered a recession. It's just that most people are unwilling to admit it. Australia's economy will face a real challenge in 2024. Whether the economy can improve ultimately depends on whether Australians can create more value. Factors like interest rates and supply-demand are merely temporary elements and cannot fundamentally increase value output. 2024 will also be a significant test for the property market. Different cities, suburbs, and property types will each exhibit their unique trajectories and market trends. In short, I predict that Sydney and Melbourne markets will stay flat or even enter declining phase before an interest cut and/or APRA lowers the serviceability buffer, which will boost demand. Brisbane, Perth, and Adelaide will perform relatively well, but are facing the challenge of high interest rates for longer and fluctuation of international commodity prices and demand. The economy depends on iron ore, coal, and lithium. We'll be on a break from next week and return from the third week of January next year. This is in line with your schedule for buying, selling, and investing. If there's something important during the 4-week break, I will upload new videos. If not, I will see you next year. Warmest wishes for a joyous holiday season and a happy new year. If you've made it this far, please give me a thumbs up, subscribe, and share this video with your friends. Turn on the notification bell to watch new weekly videos, and have a good one. Bye-bye.